JC, I think we did it. I think we're actually live on Facebook as well right now. Hello, everybody on Facebook. My name is Jeremy Blossom, and I am with tradestocks.com. And we have one of our editors here with us today. He is a chartered market technician. His name is JC Parets. He's actually a really good friend of mine as well. And him and I have been talking on a regular basis over the last week or so. Given the circumstances, I'm picking his brain on what he's looking at, how he's analyzing these markets, and I'm saying, JC, what is happening? What is going on? But welcome, JC. Thank you so much for joining us today.
Listen, I'm happy to be here. I wish it was under better circumstances, of course, and we could be living it up where you are in beautiful Laguna Beach, but we're going to do the best we can.
Yeah, no doubt, man. So let's just get right down to it. I know that most of the people that are here are probably wanting to. I'm here to learn from you as well. This is some unprecedented times. I worked for a hedge fund for 7 years, owned my own financial advisory firm for 3 years before founding Strike Point and TradeStocks.com. I've been in this space for a long time, and I know you have as well. I have never seen anything quite like what we're seeing now. What's going on in your neck of the woods, and how are you processing all this?
Jeremy, fortunately, we've seen these cycles before. I'm very fortunate to have been an active trader and market participant in 2008. I had already completed the CMT program at the time. I was already a chartered market technician. So while I wasn't, super experienced, at least I had the body of knowledge to at least be aware of what was going on and try to understand it. And I think I had an inside look at that, not just because of where I was, but who I was surrounded with and the things that we were doing, literally right in the heart of Wall Street in Midtown Manhattan, which is, where the big stuff actually happens, not downtown. And I think that learning experience for sure. And while I did have some successes then, I definitely made a ton of mistakes. And this time it's been a lot calmer. There's more yoga involved. There's no television involved. Life is much different this cycle than when I was 26 years old, the first time I saw something like this.
Yeah. Life is different, I think, for everybody. Never in my wildest dreams would I ever think that I'd be under quarantine and having to keep my distance from other people. But this is the world that we're living in right now. My kids are really curious and wondering what's happening. They're talking about it in their elementary school. So this is crossed over every single generation in our population, and it's affecting every single one of us. And it's also affecting, unfortunately, a lot of business owners and a lot of people who are in between jobs or work hourly jobs are also being decimated. And it's heartbreaking to see. For us, you and I, we're looking at these markets from two different perspectives, right? One is, what should I be careful of? I don't want to, buy a grenade. I don't want to get into some situation where it's going to cause wreak havoc on my future, my 401k and my retirement, things like that. And at the other side of it, I'm also looking for, where's the best opportunity? Where can I put my money? And so for those of you guys who don't know JC owns a service called allstarcharts.com. It is an absolutely amazing service where he has some of the biggest hedge funds, traders, institutions as clients. And he's paid to give them research and insights on what he sees happening in the markets. He has a huge retail, or what we call retail, which is like your everyday investor membership group. They're avid fans of you, JC. It's really cool to see. They love you, and I understand why. I'm a huge fan as well. And so that's his background. The other night, JC did a monthly call. Now, he does these calls just with his premium members only. So you've got to be a part of his service. But I watched the whole thing, and I literally asked him, I was like, hey, this is with everything that's going on right now. Can you just share this with everyone? Can you talk about what's happening? And can we do a Facebook Live? Can we do a huge, impromptu Zoom meeting with all of our subscribers so that they can see and hear everything I just saw. That's a big reason why you're here right now, JC. I'd love to turn it over to you. What we need to do, I think you need to take over the mouse controls and be able to share your screen.
Sure.
While you're getting that set up, like frame this for everybody. Okay, so it is 1:05, and we'll do that. We were going to start at 1 o'clock. So this is an impromptu webinar with JC Parets, and he is a chartered market technician. What that means is, number one, that's rare. So there are only about 2,500 chartered market technicians in the entire world. JC, you're one of them. He actually, an interesting fact, you're also a sommelier officially.
I passed my certified sommelier exam a couple of weeks ago. So some might say I am a professional drinker now as well, Jeremy. Do me a favor. Can you let me share? You have to stop sharing for me to share. It's telling me.
Yep, I will do that. 1 second. Stop share. All right. Okay.
All right. How's that?
Yeah, there it is. Perfect.
All right. So listen, I think, Jeremy, to answer your question, I think, now more so than ever, we need to zoom out, right? Whenever in doubt, zoom out is really how I look at it. Daily charts these days don't do much help because they've gone straight down. We really need to zoom out in order to be able to see like where we've come from. And, just really right off the bat, I mean, let me just get my, here we go. So basically what you're seeing here is a failed breakout. I mean, this is just classic failed breakout. We were telling all of our clients 3,000 is the point of no return. If we're below 3,000 in the S&P 500, worst case scenario, we were calling it the disaster scenario. Worst case scenario is on. And for those of you, by the way, wondering where these levels are coming from, these are Fibonacci extension levels. These are just classic levels that the market loves to stop going up when it reaches. And this time is no different. You can go to allstarcharts.com/Fibonacci, and I lay out exactly how I analyze and why it is that we look at these numbers. And just for those of you maybe that are new to my analysis, just understand these levels were there a long time ago, years and years ago, and now the market's reacting to them. So it's really interesting. We take these Fibonacci levels and we take it back to the 1987 crash. That puts about 2,400. The 2,400 level is really a big point of no return at this point. So 2,400, as far as our work is concerned, that area. And Jeremy, we don't draw these lines with pencils. We like to draw them with crayons, right? So think about like a little kid jumping on a mattress. It's got some give. So that 2,400 area is really a zone that we really want to see hold. If that breaks, then I think there's a lot more downside to go. So that's a good level where we feel comfortable, at least for now. And here's just a closer look. The late 2018 lows where the market bottomed before entering last year, and it had a great year. That's where markets are holding so far as of Thursday. Now, there's no evidence whatsoever that this is it, right? The fact that we've held there is interesting. It's constructive, but we've yet to see the breadth improvement to confirm that, yes, in fact, that was it. And that's a big point that I want to make, the breadth improvement. Here's the Dow, same exact thing as the S&P. Here's the extension from the 1929 crash, really showing that 2,600 level, 26,700 area as the big one, which was the same point of no return as S&P at 3,000. Equivalent levels, if you will. Here's just a closer look at that. 26,700, when we lost that, that was all she wrote. So let's get into the breadth. Okay, one of the things that we want to look at is when the major indexes are doing one thing and then the components underneath are just not doing that. So this goes back to our February monthly conference call, Jeremy, the one you mentioned that we do on a monthly basis. The one from February was on February 10th, and we were looking at how the industrials were making new highs. The transports were not. It was one of the big reasons why we were bearish at the time and raising cash well before any of the markets started crashing. I said it the other day, and I couldn't believe I said it, but it's true. This is the market. I've studied every market crash throughout history. I think this was the one, because we have the most data today. I think by definition, it was the one with the most warning signs before the crash. And I can say that confidently. That was one of them. Here on February 10th, we're looking at the advanced decline line, making lower highs, not making higher highs like the S&P 500 was doing. Beautiful, classic divergence. Sure enough, market crashed. Not a surprise, right? We had the list of new 52-week highs. S&P makes new highs. Fewer stocks in the New York Stock Exchange are making new highs. What do you know? Market crashes, right? So again, more and more warning signs. So now, what are we looking for? Like, great, JC, thanks, right? What are we looking for moving forward? Well, we're looking at the exact opposite. Instead of breadth divergences like we were seeing in December and January before the market peaked, we're looking for breadth improvements that we tend to see before the market bottoms. So here, for example, a classic example, 2008, 2009 lows. Notice how the list of new 52-week lows peaked in October, Jeremy, right? It wasn't until the market bottomed in March when the S&P and the Dow made their final lows, right? When the S&P 500 bottomed, the actual bottom of the market of stocks was in October. So from there, by the time the indexes peaked, most stocks had already bottomed out. We call that breadth improvement. Same thing in 2016. Notice how with new lows into February of early 2016, below the January lows, we only had a fraction of stocks on the New York Stock Exchange making new lows. We had already seen breadth improvement. In other words, most stocks had already bottomed in January. Emerging market stocks bottomed. I remember specifically copper bottomed. There were a lot of bottoms in January. The laggards bottomed in February, but that was breadth improvement. Same thing with stocks showing momentum, bearish momentum characteristics. We see fewer of them, right, with new lows in the market. So those are the breadth improvements we're looking at. This goes back to 2016, same thing. Fewer stocks making new 52-week lows. So we're not seeing that now. Bearish momentum divergences in February, right? And now we're not seeing any divergence. We're seeing more new 52-week lows. We're seeing more stocks showing bearish momentum characteristics. So we have yet to see that breadth improvement. So what are we looking for? In the 2018 lows going into early 2019, we saw breadth expansion at that low, right? We were seeing the percentage of US sectors making new 21-day highs, which is basically new monthly highs, if you will. We saw that expand. Same thing with the percentage of US sectors making 63-day highs, which is basically a quarterly high, also expanding. Those are the types of things we're looking for. In 2018, we saw more stocks showing bullish momentum characteristics. That's what we're looking for. And that's just simply not something that we're seeing right now.
Yeah, I love that. So I hope everyone loved what they just saw, because this is exactly the type of stuff that people need to hear, because you were one of the only people that I know that was out of the stock market back in January. You do you want to go into that trade a little bit? This was a really, really great case of you using what you do best, which is technical analysis, to find these specific opportunities. Go ahead and get into that.
Sure. So probably the best way that I can put it to show you guys, a lot of that had to do with the bond market specifically, right? Which going into January, what we were seeing was interest rates. If you pull up a long-term chart of interest rates, it continued to, since 2012, try to break to new lows, right? Below that 1.3, 1.4 level. And Jeremy, for me, the thesis was if interest rates are about to completely collapse, right? Because the way I learned it is the more times a level is tested, the higher the likelihood that it's going to break. So if the US 10-year yield is going to collapse, is that happening in an environment, which we thought was a very high probability, by the way? So is that going to happen in an environment that stocks are doing well? Or is that in the type of environment where stocks are getting destroyed, right? Yeah. And while gold, the US stock market, and US Treasury bonds were all within 1% or 2% from new 52-week highs, right? Think about that. Going into January, February, one of them didn't fit. My bet was that one of them was not going to continue in that direction. And if it was interest rates collapsing, my bet was that bonds were going to explode and that interest rates were going to completely collapse. Sell stocks, buy bonds, sell banks, raise cash, right? So it was more like a lot of unknowns, go to the safest of all havens. And what are the safest of all havens? Cash, US dollars, US Treasury bonds.
Yep, and that's what we see. All the smartest players in the game doing this, they're all going and going into cash. They're trying to get safety. This is what we're seeing when you get everything that becomes positively correlated to one another. The modern portfolio theory and a lot of other analysts will say that, have a 60-40 blend of stocks and bonds, et cetera. But during times like this, everything becomes extremely correlated because of this flight to safety. And it's not gold this time, it is cash due to the circumstances. And so, yeah, you saw a bunch of things that were alluding to the fact that, hey, stocks aren't going to be favorable, let's get out of it. And not only that, but case in point of some things that you're able to do, you're able to go and say what you shouldn't be owning and what you should be owning, right? Those are the two big things. You also talked about in that call, and I think it's really important for everyone to hear, not trying to find and time the bottom of the market. Do you want to get into that?
Yeah, that's I love that, this is something you enjoy doing. When we talk about other things, you're talking about the trades that you have on a given day. So, I mean, it's quite obvious that you appreciate this sort of thing. So I kudos to you. You're a market dork just like I am.
I love it, man. I've been trading since 2004. So I'm always trying to find opportunities. And yes, I do buy a lot about my trades.
No, all good. All good. So this is what you mean. So I know for a fact that I'm not smart enough to pick the exact bottom. I know that for a fact. You, ladies and gentlemen out there, might think that you're going to be good enough to find the bottom. And if that is how you feel, I wish you the best. And then come call me when you realize that you're never going to be able to do that. So, but all good. Go for it. Try. You got to learn. You got to learn. So go for it. I'm not going to do that. I've already learned that. A long time ago, I learned that. So I would much rather pay more to know that we are already on the way back up rather than pretending that I'm going to be able to find the bottom. That's really what Jeremy is alluding to. So here what we're looking at is the percentage of stocks in the New York Stock Exchange that are above their 200-day moving average. Basically, to summarize that, it's how many stocks are in uptrends, right? Because if you're above your 200-day moving average, you're probably not in a downtrend, so probably things aren't that bad. So we're looking at the percentage of stocks on the New York that are in uptrends for all intents and purposes. For me, it's not buy stocks when we get below a certain level, right? What we want to do is buy when it gets above, right? So it's not when there's fewer than 15% of stocks in uptrends, it's when we get back above. So this chart goes back to December of 2018, okay? We were super bearish going into October, November. The market was falling apart. So we were in a similar situation to now where it's like, okay, we were right. Bonds did great. I mean, it was literally like deja vu all over again, Jeremy. But our bonds hit our target, stocks collapsed, great. Now, when do we start buying? Now, when do we flip that trade? So this chart is, the reason why it's blurry is because it's literally a snap of the December conference call from 2018. So what we were looking for was for it to fall below 15, and then we were going to buy when it got back above, just like in 2016, just like in 2011, just like in 2009, right? Well, what happened? We broke below 15 at the end of December, came back above in early January, and 2019 was one of the greatest years of all time. Fantastic. Now, currently, we are below that 15% threshold. So now the ears are up. Now it's like, okay, the trick, the signal is there. Now we're just waiting for the entry point. And I think the entry point is when we get back above 15%. That's the one that we're looking at.
But why? Let's get into I love it because you and I talk about this a lot, but it's because of the risk to reward ratio, right? If you're trying to time it right now, when it's below that 15%, it could stay there, you guys. Do you want to keep your money in these just dogs of stocks, right? Or just things that are completely out of your control that have nothing to do with the company itself? No one wants to do that, but this is an important thing about allocation and trading in general. Allocating your capital, that capital needs to be working as hard as possible for you. Every single second it's at risk. Every single second's at risk. So why would you do that? Now, are you going to be able to time that bottom? No, I'm wholeheartedly in agreement there. I think that you're not. I don't think it's possible. I think there's some people out there can call things ahead of time, right? But the exact timing of the day, hour, or minute that you get your money into the stock market to buy some of this stuff, Would you say it is wise or foolish to try to be dollar cost averaging into the markets right now?
Well, I think that depends on who you are, but to your earlier point about the risk versus reward, it's also the probabilities, right? The
Yeah.
probability of a trend continuing is much higher than for a trend to reverse. So if you're waiting for a reversal, you are by definition trying to do something that is much harder to do, right? That happens less frequently. So that's another reason why we wait till we're back on the way up to increase our probabilities of success. So it's
Yeah.
not just about, right, which is obviously risk versus reward is the best, but now we're adding a layer of higher probability to that favorable risk versus reward. So a killer combination if you get it right, I think, Jeremy. Now, to answer your question about the dollar cost averaging, listen, folks, if you have a 401k or you have whatever it is that your system is where you're putting money in every month, which I think is great, I think that's fantastic. You know why? Because you're going to buy at the top, guaranteed, but you're also going to buy at the bottom, guaranteed, and you're going to buy everything everywhere in between. So the compound interest, if you're 30 years old or 25 years old or even 40 years old or 50, whatever it is, that compound interest, when you look at a chart, man, at the end, it goes straight up. It goes parabolic. It's fantastic. And the way to make that parabolic move at the end even more explosive is to double up when markets are in quote unquote turmoil, right? It's kind of like adding juice to that dollar cost averaging. But this only works if this is something that you're going to do every single month for decades upon decades. If you don't do that, the math doesn't work that way, right?
That's
So for
right.
the math to work, you have to always do that. That's one thing. What we're doing now is something completely different. This is tactical. We are looking for opportunities to buy. This is something totally different. One strategy for retirement that I think is fantastic, because as Warren Buffett said, Jeremy, compound interest is a human being's greatest invention, right? And it's
Yes.
true.
Yeah.
I mean, that chart is sick. But that's one thing. And then this is another where we're looking tactically for opportunities to buy and sell stocks.
Yeah, absolutely. And that's a good point. I mean, that risk reward ratio just isn't worth it. So for a lot of people out there, I would say just try to avoid that at all costs. And you made a really good point. If you're dollar cost averaging every single month for 20 or 30 years, then you buying these dips right now and keeping to that program, all the wiser, all the better for you. But for those people that are out there who are itching, they're seeing a market come back 25, 30%, thinking everything's on sale, big time on sale. They're seeing Amazon, they're seeing Apple, they're seeing some of these huge brands just fall off the cliff here. This isn't the time to get cute. This isn't the time to say that, and by the way, JC and I talked about this earlier today. The market's literally, it looked like today all day long, it was trying to kind of creep back up. I mean, yes, this could switch. And a lot of people want to be like, oh, I told you so, look, I was the one that said that you should have bought. No one knows what the future holds at all. And so why try to get yourself into a position where you could be dead wrong or it just trades sideways? We want to try to find opportunities that have a very, very low downside potential with a very high upside potential. And that's exactly what your philosophy is. And that's something that we have in common.
Listen, the circumstances are what they are. We're gonna look for stocks that are bucking the trend, and it's interesting. You can see this this slide here where we basically built a custom coronavirus index where we are looking for all of the names that have different exposure. Here, like for example, they're consumers. They're emptying shelves at the big box stores to stock up on supplies is great for Dollar General. And late stage trials for potential treatments for coronavirus and Gilead Sciences and like Slack, right, where we use for work all the time, and Zoom, which we use, like myself and a lot of us, we use Zoom all the time. But now, like, my mom is calling me, she's like, hey, I'm using Slack and Zoom, and I'm like, go mom. So we created this index, and honestly, Jeremy, I was looking up just a couple hours ago, I was looking up the stocks and I filtered by the highest momentum readings, and a lot of them are the ones on this list, right, for the most part. So it's really interesting how the story makes sense with the actual mathematics, and we're less on the story and more on the math. Like, we don't really care if it has anything to do with coronavirus or not, but the market is certainly acting that way. So here's that list, and you could just see, you know, the average stock on our index was up as of the time that this list was put together or updated last, and with the S&P 500 down substantially. So just recently, the coronavirus index is an equally weighted index of all those stocks, putting in higher highs with the S&P 500 falling apart. And then here's that coronavirus index versus the S&P 500. So a ratio of that list of stocks equally weighted versus the rest of the stock market, if you will, and just look at the tremendous outperformance. So I think what this speaks to is relative strength. There's actual accumulation taking place underneath the surface, despite what is happening in the greater, in the bigger markets, right? So I think that's really, really powerful information. A lot of positive momentum coming from these names. So just a few, and just to put out a couple of good risk versus reward opportunities. I know, Jeremy, you know, your readers and your followers love a good trade idea just as much as you do. So let's get into a few of these names. Here's Clorox, right? Quite obvious why this is on the list. I like $167 if we're above 167. I like it to go to 190. Right? We're looking at, that was the original trade, right? So this is from March the 5th that hit our upside target of 190. So now moving forward, we want to only be long Clorox if we're above 190 with a target potentially towards 205. And hopefully, I think it stays in that range. If it starts to fall below 190, I think all bets are off on Clorox moving forward. Zoom video, quite obvious if my mom's using it. Words getting around that it's popular. I want to point out, Jeremy, look at the relative strength. Can you see that down here?
Yeah. Mm-hmm.
So this is Zoom relative to the S&P, and just look at this beautiful base, right? So it's breaking out on a relative basis. I think it looks great on an absolute basis. I think that if we're above $110, we can be long Zoom video. I think you could go to 150. Look at Gilead. I'm not going to pretend to know anything about viruses or drugs or anything like that. I'm the last guy you want to talk to when it comes to that. But as far as the supply and demand dynamics of a company who could be responsible for something like that, I certainly like the action. If we're above $80, only if we're above 80 do we want to be long Gilead with a target of 92 and ultimately 112 from there. But it's got to be above 80 for us to get involved. Regeneron, same exact thing. I'm not going to pretend to know what's going on. They may or may not have a solution for this, but I will say that if we're above 460, we want to be long Regeneron with a price target of 600. And Domino's Pizza. I mean, who doesn't love bad pizza, Jeremy? I mean, you live in California. I mean, you guys know bad pizza, right?
Yeah. Touche. It's true, actually.
All right. So 300, Jay. 300. If we're above 300, we got to own Domino's with a target of 384. And DocuSign, I know you and I live in a digital world. This name is no secret to you, I'm sure. We want to be long DocuSign for above 77 with a price target of 88. And then the grocery stores, Jay, the grocery stores are bananas these days. So there's a lot of small businesses and businesses in general, particularly the service industry. I mean, it's a complete disaster what's going on, but that is certainly not trouble for Kroger. They are certainly benefiting from the situation. If we're above 31, we want to be long Kroger with a price target of 42.5. And that's what I got. What do you think?
I love it. I love that you brought those. I think a lot of people who are watching are like, sweet, I showed up. I got some really good picks. And one of the things that I always admire about you is how you present these ideas to people. I've seen you speak, you do it to me as well. You always throw this one key word in between before you say it. I don't know if you even notice it, but it's if. So when you're looking at something, if it is doing this, then do this. It's like an algorithm. You know what I mean? Like you're like a human algo, because that's exactly how these algorithms are written. A lot of people don't know this. It's just an if-then statement. If this, then you do this. If this, then do that. So you are basically looking at this from a quantitative perspective. And I like something you said at the very beginning of our webinar, which is, guys, the longer the time frame and the more data you have, the more certainty you can have about whatever it is that you're looking at. And so looking at certain things, I know a lot of people, my friends are texting me charts, and they're 1 minute charts, and they're trying to predict, or 5 minute charts. And they're like, look, this is going to, and they're trying to day trade these markets. It's like, whoa. Like, you got to go way out and look at these long-term trajectories, right? And then part is, if this happens, then you want to go and do this. I love that. Is that how you've always done it, JC? Is this like, talk about this, so crucial to how you make your recommendations?
Like anything else, Jeremy, you need to, you got to have your bumps and bruises along the way so that it finally gets through your skull, that if you don't walk up to the pretty girl, she's never going to talk to you, right? You got to, whatever. You got to learn your lessons, whatever those lessons might be. And it's funny you said if then, because the market is a very humbling place. And if you think for 1 second that you know anything about what's going to happen, which is why I laugh at these, every December they prance around, all these sell side analysts with their year-end targets. It's the most ridiculous thing I've ever seen in my life. And year over year, they do the same thing. How are those year-end targets looking like now? To think that you have any idea what's going to happen in 12 months. Jeremy, I don't know what I'm having for dinner tonight, yet alone what I'm going to be doing in December. You know what I mean? Probably wearing sweaters. I mean, who knows, right? The point is, like, it's all dependent, and it's all about risk management in our case. So in the case of Kroger, if the stock isn't above 31, there is more risk to the downside or sideways. Either way, not something I'm interested in owning, right? So it's only, the path of least resistance is only up, in my opinion, in my humble opinion, if it's above 31. If it's not worth the aggravation. There are other places to be, right? So even if you don't lose money, it's also the opportunity cost that you really need to weigh as well.
Yeah, you're 100% correct. Then there's another whole side of this thing that I want to talk about, everybody, is now that you've given out some ideas on where places that people can look at to make money in times like this, things that have that good risk reward ratio, and you did a great job explaining that. But here's something else that everyone needs to consider too. You and I talked about this, and I really appreciate you doing this to the Trade Stocks audience. You have decided to do something really cool. If our team could go ahead and drop the link here, we're not going to go into it, but basically all the different features and benefits. But what you've decided to do here is you've taken your service. This is a $1,600 a year service. Like I said, you've got the biggest banks in the world, some of the biggest institutions, biggest hedge funds, all go to you and say, JC, what's happening? And I think everybody who's been watching here is like, okay, this guy knows his stuff. And not only that, but you gave out some really good picks. But here's the biggest thing. What do you do when you're in the pick? What do you do when you're in the stock, right? You need to be able to manage that risk reward ratio during the entire spectrum of that investment. If anybody here wants, and if they got any value out of what you just did, JC, and you want to go and take and be a part of his community, there's a link. And what you've done is you've taken a huge discount off the price. There's a 30-day money back guarantee that you threw on there as well. And I know your heart, man, you're here to help people. You want to be able to go and help investors find these opportunities. It is not as, the U.S. is going to be here at the end of the year. These are some things we can say. The markets are going to be here. These businesses are going to be here. This is a very tough time. And you need to be prepared. You need to be prepared to manage your portfolio and make sure you're not doing anything frivolous with it. But you also need to be keen and prudent and tactical and find these opportunities where you can make money. That link right there is the perfect way if you want to get started on following what you're doing, getting really, really good, low risk, high reward trades sent to you. And not only that, but access. I mean, this is the exact same access that these hedge funds and institutions have of you. I mean, you get to have access to all of these charts. Now, this was probably 10 minutes of maybe 15 minutes of an hour-long call. I mean, you went through how many slides?
Not quite as many as I brought.
Yeah, I mean, you went through a ton, man. So it was absolutely incredible. So like how in depth you get how succinct that you are with your analysis is something that I've grown to really love and appreciate. I don't like to live without it. And I've become one of your biggest fans. And that's why I wanted you to come on today, is to talk about what's happening and how you're looking at things. I hear all these people on TV talking about, well, the thing we need to do is just lock the country and then the stocks will do this. And it's just all this theoretical. It's not any real like quantitative ways that people are really looking at things. And you did that today, which I really appreciate. I did want to open this up to some questions, some Q&A if they have them. And one of the questions I've already saw in here, which was, what do you forecast for the year end at 2020? I think you already answered that. But if you wanted to go and tackle that more, and if anybody has any questions, a section here, please, we'll leave that link up during the duration. If you're watching on Facebook Live, in the comment section, the link as well.
I think if we are above 2,400 and we start to see improvements in breadth, I think that we can recover pretty quickly, is how I feel. If we, again, there's my if then statements. There I go again. If we are below 2,400, I think risk is incredibly elevated in the same ways that in early February and late January, we were like, listen, this is a correction. We don't know how deep it's going to get, but if we break 3,000, things are going to get a lot worse, right? That was essentially what we were saying, and that's precisely what happened. So here we are saying, okay, we could potentially break down further. There's no evidence whatsoever that the bottom is in. Can it have been in? Sure. Would that bottom come from a perfectly logical level? Most certainly. Absolutely. Those former lows, we had historic bond moves and volatility moves that, again, tend to come at bottoms, the extremes in sentiment. All of these things are classic bottoming behavior. Classic. But we have yet to see that impact price. And when I say price, I don't just mean the indexes, I mean the components thereof. I would say that today, Thursday, is a great start. I think the fact that copper rallied on Thursday, 10% off the lows or more, I think is incredibly constructive. And again, consistent with all those things that should come at a bottom. Now, what we're looking for is follow through. Do we get breadth expansion on this, or do we deteriorate once again and start making new lows? I think from a price standpoint, 2,400 is a good number on the S&P. If we're above that, the world's not coming to an end. And I'll stick to that.
Yeah, I love that. Someone asked, what's your opinion on Uber and Lyft?
They're not on our coronavirus list for a reason. It's like the antithesis of the coronavirus index. It's just not, once we broke those former lows from last year, that was all she wrote. No reason to get involved. We'll look for names showing positive momentum. So it's less about what the former leaders were and more about discovering what the new leaders will be. And we've studied every market bottom in history, and the new leaders start poking their head up first. They don't just lead eventually. They start leading from the start. So Uber and Lyft are certainly not on that list. At least they're not on that list yet. Nowhere near getting to that list. There's already stocks shining. And I think that for now we focus on those. And I showed you a few.
Yeah. Great answer. I completely agree. Those are not ones during the coronavirus that you want to be touching with a 10-foot pole.
Yeah, the opposite.
This is a really critical, going back to one of the charts that you showed about the 2018 level. We're here right now, and you can see the market is just testing this. And we've been here now. As we get more information about the coronavirus, as that comes out, a lot of people have to understand, and you showed this a couple times in your charts, that, look, guys, the market could bottom out well before the coronavirus hits its peak. So you got to understand that at every single second that the markets are open, we're trying to price in what the future is holding out for us. So with the sum total of the information we have, what do we think the future of the market's going to be? And then let's factor that in now. And so this happens. You're about to show this.
So here is what we're looking at. Those are those former lows. And we have a slight bullish divergence. I got to tell you, I don't love how little it is. It reminds me of this guy here in October of 2018, where we got a little bit of a rally and then new lows. This looks awfully similar to that, how tight it is. So I don't love that. And I think that increases the probability that we break if we're looking at just this in isolation. When you match all that volatility and everything, I think perhaps that could be a good low for now. But I think that breaking, Jeremy, I hate to say it, is still vulnerable, still very much on the table. And if that breaks, you're looking at another 20% drop probably.
Yeah, and that's the key right here, you guys. And so, again, this is not the time to try to pick bottoms. That's not the point of what we're trying to discuss here, is that this is when we think that hey, we think a bottom's nearing. These are just really critical levels that oftentimes we'll see some sideways momentum happening, or maybe some dead cat bounces come off of this. There's a lot of other factors with technical analysis and the way that you are specifically looking at this. There's a few things that you can consider doing, which is just keep your powder dry and wait until. Now, you're not going to be at the bottom. It's going to trough out, and you can start to put some things back, some of your cash back into the markets. Or you can look at some of these things where, not all stocks are going to fall in line with everything that the S&P is doing every single day. And there could be some things like Zoom and the stocks that you've already mentioned. But those are things to consider. What else should we go over, JC? I really appreciate your time and for you doing this so last minute.
I think what's important is to really understand from a intermarket perspective. Let me just share this quick so you can see what I'm referring to. So there's a large number of investors out there that are long only. And what that means is that they can only buy stocks. They can't short stocks. They can't raise cash, because in their mandates for their mutual fund or whatever it is that they're managing, it says that they can't, they have a mandate where they need to be long only and be very long at all times. So how do they get their bonuses? How do they, get their bonus checks at the end of the year? And it's by generating alpha. And that's what they're looking for. So it's the difference between what the market does and the performance of their fund, right? So when the markets are falling, actually, do I have... So when the markets are falling, right, or these long-only managers think the market's going to fall, the way they outperform the market is not by shorting and raising cash. It's by putting money into consumer staple stocks, right? Tobacco, no matter how bad the economy is going to get, we're still going to brush our teeth and wash our dishes and, drink beer and smoke cigarettes, right? Those are consumer staples. So these mutual fund managers, these long-only managers are going to buy those stocks. They're not going to buy consumer discretionaries, which are retailers, home builders, automobiles. They're going to sell those stocks, right? Where we spend our discretionary income, if you will. So think of it like a cruise ship. You can really see the shift happening. It doesn't happen overnight. So here what we did is we took that whole staples versus discretionary thesis, right, which is certainly true. We've seen it in the past. We've taken it one step further. So in the black, we're looking at a ratio of two baskets. We have one basket that's financials, consumer discretionaries, and technology. Those are the offensive sectors, right? Then you've got the defensive sectors, of course, consumer staples like we just discussed, but also things like utilities and healthcare. Well, it just so happens when you take a ratio of the offensive basket versus the defensive basket, it looks exactly like the S&P 500, as you can see here. However, at turning points, you've seen divergences that give us warning signals, right? We saw that when financials peaked in 2016, financials and home builders peaked in 2006, well before the market peaked at the end of 2007. Well, here, this particular ratio, for example, has been making a series of lower highs. This chart's from February the 10th, by the way, Jeremy, putting in lower highs over the last year and a half or so, while the S&P put in new highs. This divergence was quite obvious, as you could see here, with the no new highs in the ratio, with new highs in the S&P, and then what's happened in the last month. Everyone's like, oh my God, what a surprise. shouldn't be a surprise. We've already seen this rollover for a while. We never got a potential breakout that we were looking for. So now consumer discretionary stocks are falling apart. Amazon's breaking the uptrend line from the 2009 lows. Home builders, oopsie, right? From failed moves come fast moves in the opposite direction. Here's a closer look at that. From failed moves come fast moves. And then the home builders did not, the home builders making new highs did not get confirmed by regional banks. So divergence after divergence after divergence. So folks, if you're looking for one thing, just keep it simple. One ratio, Jeremy, I think it's this one. The S&P 500 versus consumer staples. If this chart is going up, that's good for stocks. If this chart is going down, that's bad for stocks, because this is consumer staples relative strength upside down. So now that we're making new lows in this ratio, it's consistent with lower stock prices, right? Here's a closer look. And then here's the last one I'm going to show you. If you think stocks are going up, you want to see this ratio of S&P as the numerator, consumer staples as the denominator, right? So SPY versus XLP. You want to see it back above last year's lows. If you start to see that, I think that would be incredibly constructive.
I love it, man. I love it. I always learn something from you, and I appreciate you going into so much depth with all of this, because that's important for everyone to see, and that makes total sense to me. And that's really what you guys are seeing right now, is you're seeing massive divergence. And this guy, JC, you've predicted this months ago.
In terms of the next couple of months, next couple of quarters, I think we'll look back on end of January, early February, and look back and be like, we haven't made much progress, or we're down, right? Either way, not an environment that we want to own stocks. The opposite, we rather be buying bonds.
Not only that, but all of your members heard this. They got to hear this in real time as it was happening. I am one of them, so I got the email that was sent out. I got to go to the conference call. I got to hear all of this as you broke it down step by step, and you provide so much evidence every single time you make any call, whether it's, hey, I think I'm showing weakness here, or I'm showing strength here. You provide so much evidence every single time.
Jeremy, I rip through 5,000 charts a week. I got it. For me, it's not finding the evidence. It's just limiting it to 100 charts, so I don't bring 500 to my presentations. That's the hard part.
Yeah, but they're dynamite every single time, and they all tell a story, and that's what's really key. If you guys look at anybody here watching, if you look at the best investments that you probably have ever made, every single box was checked. That every single box was checked, and the investment did really, really well for you. And so that's JC's approach. It's a top-down global macro, down to the very specific sector, down to a specific stock. And if all of that lines up, the boxes that are checked, risk to reward ratio goes through the roof. There's a massive upside potential for profit, and very, very little. And there's always an odds, right? He's not calling himself, Nostradamus, and he has some crystal ball that goes out. But more often than not, he's going to be right. More often than not, he's going to be out of danger. And if that's something that you're looking for, to be out of danger in favorable positions more often than you're not, and through this type of approach, then this service is exactly the type of service that you guys need to get and need to have. So I don't know how long we will be able to run this for, but we do want to make sure that everybody who's being affected by the coronavirus and their portfolios, and they're watching this market, that they have the ability for them to take advantage of it and get this insight, and hear from a real expert. This is not the time to try to think that you're smarter than everybody else in the room. Okay, you're going to get hurt. Rely on people like JC, who this is what they do for a living, right?
And for fun.
Yeah, exactly, true. But so do that. So one last question we'll take, and then we'll wrap it up. But go ahead, and anybody who's here, click on that link. If you're watching on Facebook, go ahead and find it in the comment section. Click on it there. The question is, what's your opinion of the cannabis stocks? Think that they will accelerate?
They might. I think people will probably be smoking more of it while they're while this quarantine is taking place. Jeremy, if I was Nostradamus, I would have predicted it and done my quarantine in Hawaii, right, instead of in the Northeast. So that's evidence that I'm not. But fortunately, we did see a lot of this coming in January. We did. When I tell you, Jeremy, from the bottom of my heart, man, I have gotten the nicest emails from people, investors all over the world. Coming, you see them, they're coming in every day. These are like such heartfelt, in some cases they're huge institutions, but in a lot of cases they're just, regular everyday investors that, save themselves a lot of money. We know that because they're telling us how much they saved in some cases or made in other cases. So, going to sleep every night knowing that we're actually helping people, real people out there in the world. And they say such nice things, man. And I meet a lot of these in person too. They've met Morgan, my wife, and she meets them. Everybody's so nice. I mean, we attract really nice nerds.
Well, it's easy to see why. You're extremely passionate about this. I think in a different life, you should be a sports announcer and call baseball games or something because you're so enthusiastic. But yeah, man, I think that you're a legend. And I mean, that little part that you said right there with all the little emails that you're getting, I mean, if you're watching this and you were in the markets, in the stock market, like in a big way in the last 2 weeks, then you need JC services, plain and simple. Because he would have told you, had you been a part of his service, that may not have been the best idea for you. And you definitely would have shown ways that you could have at least protected yourself. Now, did he know about the virus, that this was going to have this type of impact? Absolutely not. That's not what we're saying here. You're saying that there were other things outside of the coronavirus that were impacting, and everything comes.
But it's less than that, Jeremy. I didn't know about it, but guess what? The hedge funds with the most amount of money to risk in the world do have the resources and do pay people to get that information for them. And they are acting upon that. We don't know that that's what's happening until well after the fact. But why do you think regional banks peaked in December? Most stocks peaked in mid-January, well before any virus, because the biggest, most powerful institutions in the world, they have the money to get that information. I know that for a fact because a lot of them are my good buddies on both sides, both on the hedge fund side that are paying the experts and also the experts getting the information. One of my good buddies, I'm not going to say where I know him from, but he worked for the government and he knows he has a lot of contacts in shady places like Asia and Africa. And hedge funds now pay him, because he doesn't work for the government anymore, they pay him to go get information from these places. And I know this I see it every day. They're my clients as well. So we're seeing them acting. We don't know why they're acting, but we saw them acting and it was enough to get out of the way. So it's like a legal way to get inside information, I guess, is probably the best way I can explain it.
Yeah. And well, I like that. That's actually a really good analogy because that's exactly what we're offering here. We're offering people the ability to get information and insights that you're not going to hear watching Fox News or CNBC. You're just not going to hear it. You're not going to get this information on Bloomberg, and you're not going to get this information on Yahoo Finance. You guys, most investors, most of your friends that you're listening to, most of the people that you're listening to are not approaching it the way that we are approaching it, the way that JC approaches things, is in a very, very quantitative and with one really big premise here is that everything is factored into the price of what's happening right now. So every single price is being factored in, and it's so clearly evident when you look at the stock market and look at Clorox, for example. Okay, everybody's like, hey, I'm concerned about the virus. I need to clean everything. What do you think would happen to the price of the company where this is? I mean, it's going to go up, right? I mean, like these are like, of course it's being put in. But going back to your point about like getting information and benefiting from it, like I said, if you guys lost money, if you have been on the in stocks in a big way, trying to take advantage of things like Uber, for example, or Lyft, then you're missing out, and there's no need for it. It's silly, and we're giving
you guys stocks or Bitcoin. All these things are in downtrends.
Yeah, all of them. Correct. And so if you're one of these people who are just doing things off of gut feel, or if you're just, buying things, putting your statements into your drawer and not looking at them again, I urge you to take advantage of what JC is doing here today, and what you're kind enough to put in as this offer, which is an ability for people to go and get access to this really, really very, very important information. So click on that link. JC, this has been absolutely amazing. I can't thank you enough for being a great friend of mine and for providing all this insight for the trade stocks. So you're amazing. Guys, everybody who attended, thank you so much for coming. Thank you, JC. I really appreciate your time, man.
Yep, always.
All right, guys. If you guys have any questions, please feel free to tell us or reach out to us on Facebook. If you want to follow JC, you can go to chartcharts.com, and you can go to Facebook, you can go to Instagram and Twitter as well. He's big on Twitter, so follow him there. Thank you guys so much. Thank you, JC. Really appreciate it, man.